how do you define good? What does good look like in a trading system? Now, unfortunately, most unprofitable traders say that a good strategy is when they can find a few good winning trades when they backtest it, or when they trade it in the market, they get a few winning trades and they get 1 or 2% up after a few days and they think, yes, this must be a good system. But this is not how the top institutions or the top traders across the world define what is good. So let me share with you the exact definition and criteria that the top traders in the world are using when it comes to test and define what good looks like in their trading strategy. And that is, good is defined as a positive expectancy system that consistently generates more profit than losses over a statistically significant sample size through disciplined execution of predefined rules with a favorable win rate, risk-reward ratio, and risk management. Now, I know that sounds like an absolute mouthful and difficult to understand, so let's break it down step by step into an exact formula so that you can test and define your own trading system. And that means before you actually take a trade on a prop firm evaluation or actually deposit your hard-earned money before taking that trade, make sure you have a system that is actually defined as good through the following principles. And if you can't do that, then stick around for the rest of the video, because I'm going to be sharing with you an exact strategy that fits the institutional formula of what is a profitable system, what we call good, that by the end of the video you'll completely understand and most importantly can copy and paste step by step into your own trading system. So let's break down exactly what is good, the key components of each one, and then together we can build an objective, data-backed system like the pros are doing. So let's do this all together. Step number one is going to be understanding what is good. So good is gains over objective data. The pros, they don't look at random winning trades because random winning trades are absolutely meaningless. Think of the analogy of a casino. Now, the casino on a single day, if they have a gambler that walks through their doors and they lose their life savings and the casino makes a great amount of money, they don't get exceptionally happy. And on another day, if another gambler walks through their doors and they hit it big, they make so much money that the casino has to pay them out. Once again, they do not worry. Why is this? Because from day-to-day fluctuations, yes, you're going to have winning days for the casino and massive losing days for the casino. But their key is time, and they have data-backed systems on their side. What that means is when you look at the spin of the roulette wheel, now that roulette wheel looks like a 50-50 chance for the gambler because they just need to pick red or black. And the chances of hitting red or black seem to be 50-50. But the reality is that the casino has 2 green squares. That means it goes towards the house. So yes, a majority of plays is almost a 50-50 chance where the gambler is going to win some money or lose some money. But over time, the maths is going to unveil itself. Yes, it's going to hit red thousands of times. Yes, it's going to hit black thousands of times. But when you break down the numbers, it's not 50-50. It's actually something more towards 48%, and a few percent towards the casino because of the green squares. That means as long as the casino is up and running and gamblers keep walking through their doors and keep playing that game, yes, majority of the times it's going to be red or black. So majority of the time, the casino is going to win or lose some money, but that's not where their money is made. Their guaranteed profit, their positive expectancy, or their gains over objective data is the fact that they have 2 green squares that is always going to be for the house. And that skews the odds from 50-50 ever so slightly in the casino's favor. And that's why they say the house always wins. And you'll see that these casinos have stood the test of time. They've been around for hundreds of years. They're some of the oldest buildings in major cities, and they stand financial crisis, they stand recessions, they stand pandemics. Where most companies go bust, the casino always stands. Why? Because they have a positive expectancy, because they have gains over objective data. So let's break this down. Positive expectancy is very simple. Your average win in dollars multiplied by your win rate has to be greater than your average loss in dollars multiplied by your losing rate. So let's look at it in another way. Let's say our win rate is going to be 50%. Therefore, our loss rate is going to be 50%. But our wins in dollars equals $300 every time we win. And every time we lose, it's $150. So therefore, when we put the numbers into the formula, our average win is $300 multiplied by 0.5. And we have to see, is that greater than our average loss, which is $150, times by our loss rate, which is 0.5. And that translates to 150 is in fact greater than 75. So we can see we have a positive expectancy over here because we know that our wins and our win rate in conjunction is going to be greater than our losses and the size of our losses. Or in other words, a positive expectancy is the relationship between your win rates and risk to reward for your winning trades and your losing trades, and then overall converted to dollars, which one is bigger. So that's why traders sometimes hyper-focus on a really high winning rate, but a low risk to reward. And that's why you have 2 camps in trading. You have some traders that focus all on a high win rate. They want an 80% win rate, but they don't mind a 1-to-1 or a 1-to-2 risk to reward. But other traders, they're happy with a 20% win rate, but they focus on 1-to-10 or 1-to-20 risk to reward setups. When you do the maths, both of them have a positive expectancy, and you can mix it up in any way that you want. But the mistake becomes when you have a a low risk reward, let's say you only trade 1-to-1 risk reward and your win rate is 20%. When you have it like this, then it's absolutely flawed as a system because the math doesn't add up. Now, the next part of our definition was statistical significance. Most traders focus on a small sample size of a few trades, or they backtest for a couple of hours, they go through 1 month of price action and they say, yes, this is enough for me to test a strategy. While you need to have a minimum 100 trades to validate a hypothesis, this is the minimum requirement to say this is not random, chance, or luck, or that the market was trending in a specific way. You actually have to have a sample size that is enough to take out chance, luck, and anomalies and seasonality and tendencies, because the market can evolve from summer months to winter months to different political and economic and election cycles. So you need to have a sample size around 100 trades and beyond. I like to actually pair it with 100 trades and a minimum 6 months. For example, some traders that are scalpers, they might get 100 trades in 2 weeks. So for them, they need to stretch it out over time. But the key here is that you're trying to get enough data to say this is not luck, this is not chance, this is not an anomaly. This is a system that is backed by data, which is the definition of good. And I know that if I continue to trade in this fashion over time, yes, I might have some losing periods. Yes, I might have some crazy big periods, but over time it's calibrated towards my positive expectancy. Now, the variables I like to look at for consistent KPIs is going to be your win rate, your risk to reward, your risk management, your trade frequency, and this is going to be the core KPIs of a strategy. For example, if you have a strategy that has a very high win rate, for example, 80%, you have a very high risk reward, let's say always a 1 to 5. Your risk per trade is 1% and it's stable, and your trade frequency is every day. Then it's mathematically proven you'll be very wealthy, because every time you take a trade, majority of the time you win with a very high risk reward with good risk, and it's every day. Meaning every day you risk 1% to make 5%, and only 20% of the time you lose money. You can actually scale up to hundreds of percent per quarter just by following the maths here. Now, is that realistic? Is that sustainable? Probably not, so let's not get our hopes up. But you can just see these are the moving parts. Now, if you have a system that has a win rate like this, a risk reward like this, risk management you follow like this, and it's not all over the place because of bad management systems or psychology, but instead of every day, it happens once per year, then this is a very good system, because majority of the times you win a lot more money than you lose, and you're following stable risk management, but it happens once a year. So yes, you have the potential to make a lot of money, but it's going to take you years and years and years just to make 50%. So this would then be not a good system. Or if we now say we have a 1 to 5, 1%, it's every day, but the win rate is just 10%. So we do the maths and we realize, even though this is great, this is great, this is great, the positive expectancy is not there because our win rate is in the floor. And even though we win more money than we lose when we get a winning trade, we lose too often, and overall we're losing money. Now, a few other bonus variables is going to be when you have your risk per trade, you can do dynamic, which means sometimes you risk 0.5% per trade, sometimes you risk 2%, sometimes on really high conviction plays, you place 5% risk per trade. So now this is going to depend. You need to have a strategy for that, which is why it's a bonus thing, because let's say all of your winning trades happen to be on the 0.5% risk and all of your losing trades are on 5%. That is bad luck, but it can happen and you need to factor it in. What about how many losses you take in a row? What is the system showing? For example, if there is a chance in your system you can have 10 losses in a row and you're trading 10% per trade, then at some point you will 100% blow your account. So you need to know the chances of you having 2 losses in a row, 3 losses in a row, 5 losses in a row, and modulate your risk accordingly. Because if you have a very high win rate, a very high risk reward, then you might think, well, why not just do 50% risk per trade? Well, you know that at some point you're going to have 3 or 4 losses in a row and you're going to wipe out your capital. So there's a lot of additional things, but for the sake of a minimum viable strategy, let's focus on these characteristics or KPIs, key performance indicators. Now, if you want to have a further breakdown of definitions of each one, I've prepared for you on screen exactly each one so that you can take a screenshot, print it out, and have it on your desk so that you can help prepare and define everything for your system. And here's a quick example just so you can see it in action, so you can test your own data, your own KPIs, and make sure you got it all figured out in a correct way to make sure you have a data-backed, defined positive expectancy. So right now we're going through exactly how to build a system step by step, so that if you don't already have one, I'm going to show you exactly how to do it, how to test it. However, what I've also prepared for you, and this is exciting, is because every single quarter, what I like to do for my own system is do a system diagnostic health check. That means I go through my system step by step in detail, look at all of the KPIs, and make sure I actually still have a positive system, because I might have a positive system a year ago, but my mindset, my performance is making me deviate away from profitability. Now, with the rise of AI, and by doing it so many times over the years, I've actually optimized it into a specific system, a very short questionnaire where you can answer the specific questions in just a few minutes, and it'll give you a customized report based on the answers you gave, based on your trading system. Something that used to take me days to do, now it can be done in a few short minutes. And most importantly, once the system has done a diagnostic on your trading plan, on your trading system, on your trading beliefs, it will give you a diagnostic report on what you're doing good and what are the blind spots and what you can do better and how you can do it better through a 30-day implementation plan customized to you and your system. It's absolutely free. Just click the link in the description. It'll take you just a few minutes. And by the way, if you're interested in more personalized care, meaning one-on-one coaching, daily live streams of trading sessions, and multiple times a week Q&A, plus our custom apps and journals and systems, everything that you need, an end-to-end ecosystem, then you also have a chance to apply for WWA trading. Now, this is not going to be for everybody because we do one-on-one coaching and there's simply not enough hours in the day for me to help thousands of people. So this is going to be limited, which is why it's application only. But either way, if you're interested in that, the link is there for you. Whether you're accepted and join or don't join, my promise is we will leave you better than we found you. Okay, let's get back into the video. So let's break down the key components of how I would define a good setup, a good strategy. And I know that this is backed by data because I did the legwork that I'm recommending you all do. If you don't want to do all of that legwork, then just copy and paste the system because it is data backed, has a positive expectancy, and is trading like the pros. So step number one is going to be forgetting your market structures and smart money concepts and all these other things. Is focusing on a checklist. Now, concepts, theories, schools of thought, these are just good to know. But as you probably have realized, more information in the markets does not equal more profit, because the reality is 95% of traders consistently lose money and 95% of traders trade the same way, think the same way, follow the same strategies. And if I can find a head and shoulder pattern, a trend line, or smart money concepts online for free, and you can find it online for free, then so can the big institutions. And they know exactly how we think, where our entries are, where our stop losses are, how we react to different conditions psychologically. And therefore, these institutions can literally act as a puppet master, showing us what we want to see, convincing us to get in, playing with our psychology to get more FOMO, greed, jumping into trades, revenge trading. The institutions are pulling all of these strings so that we are consistently losing money, and they can be the counterpart to our liquidity so that they can execute their large trades. This is not conspiracy theory. This is just simply market mechanics. So to be on the right side, let's focus on step number one is forget trend, forget POIs, forget all of those things. Focus on a 1 hour impulse, meaning to say you might have a bearish market, but if you find a 1 hour impulse like this, then you take your low to high and you define that as a range. If in another case you have a market that is choppy, consolidating, it doesn't matter. You just find the most recent impulse that went from high to low. That is our range on the 1 hour time frame. That's all you need to do. You need to find an impulse that found new territory. What does new territory mean? It means previously this was the ceiling in price and this was the floor in price, and price went from that floor, came to that ceiling and broke through. So therefore we had a new high in the market. Therefore that became our range of interest. Same over here. This was the previous high. This was the previous low. This one now broke through the previous floor in price, made a new floor, and therefore that becomes our range, and that becomes the high and low of it. That's all you need to do. On the 1 hour time frame, look for new high or new low made, define it as a range and put it as bullish or bearish. So if that impulse is making a new low, then you know it's a bearish impulse. If that impulse is making a new high, you know it's a bullish impulse. Very simple. So step number one, find new territory found as an impulse. Mark the low, mark the high on the 1 hour time frame. And if it's going up, bullish. If it's going low, bearish. And that's all you need to do. Step number one, 1 hour impulse. Once you have found your 1 hour impulse, next you need to do is a very simple case of premium and discount. Now this is simplified to make sure you catch all of the valid strategies, not a specific trade setup, which I've made other videos about. This is a general system. So if I find price action that is a bit all over the place and we then find an impulse like so, then we know that in our case, yes, the market might be making recently lower highs and lower lows and we are in a bearish market. We could be coming up into that supply area. Forget your market structure, forget your POIs for now, because most of the times this misleads traders, or traders get overwhelmed and lost. Because it's very easy to get lost in market structure reads when you have internal structure, external structure, multi-time frame analysis, daily, weekly, 1 hour, 4 hour, M15, M30, M5, M1, M3, and all of these time frames have different reads, different components. And when you bring it all together, most traders end up lost and misreading things and therefore taking avoidable losses because they just simply got confused in market structure. This is how you boil it down. Forget all the time frames, forget all the trend, go on to the 1 hour time frame, find the low, find the high, find the impulse, and define it as a range. Once you've done that, simply split it down the middle, find your 50%. And you know, in this case, because it was a bullish impulse, because this was the previous ceiling in price and we made a new high, therefore we know we had a bullish impulse. I know in this case, I want to be buying below the 50%. If it was bearish, I want to be selling above the 50%. So this is simply a case of premium and discount. In this case, I'm buying. I want to be buying in discount. So once that is done, very simple. Step number one, step number two, very simple. Step number three, we need to find an M15 POI alignment. In this case, because it's bullish, we need to find specific demand areas within our impulse leg defined in a specific way. So if we are to imagine this on another time frame, what we see as a 1 hour impulse on a lower time frame naturally is going to look something like this. You're going to have a lot of things going on. So if I see that internal price action, I need to focus in on specific areas where I can see inducements. Inducements are going to be when I see a buildup of liquidity and a sweep, a buildup of liquidity and a sweep, and then followed by a bullish push, breaking the previous high, bullish push, breaking the previous high. If I can find that, these are my M15 aligned zones. So this inducement that led to an internal high, this inducement over here that led to internal high, these are the zones. I'm going to be looking at this on M5 within our 1 hour time frame impulse. So in other words, we found our 1 hour time frame impulse. On M5, I need to find these inducements, and all of the inducements that led to internal highs inside of my 1 hour push on the M5 time frame below the 50% are the zones I want to enter. Now, I'm going to say that again because it sounded like a lot of words, easy to get lost. Very simply, on the 1 hour impulse that we've already found, I'm going to now go into the 5-minute time frame, and I'm going to look for all of the buildups of liquidity, let's say equal lows, let's say a trend line, a clear flush, a clear sweep lower, and then a bullish push higher on the M5 time frame. If I can find that, I mark it out as my demand areas, and I only look at the ones that were below the 50% range. Now, you're going to end up with a lot of points of interest, and most of them might fail, most of them might not be valid. That's okay, because we're not focusing on only this, because I've already made videos about qualifying POIs, top types of POIs, invalid POIs, weak POIs, and even trap POIs. If you want to learn more about that, go watch the video. But for today's video of a minimum viable strategy, what I'm going to be telling you is, because we're not just entering on a limit on these zones, it doesn't matter if we even take weak zones, because we have further steps to qualify it or disqualify it that we're not going to get trapped in, because we're not randomly jumping in. Because so naturally you're going to have 3, 4, or 5 points of interest, but usually I'll qualify them in other ways, which you can watch the guide upon. But for now, let's make it very simple. Find all of them, because we'll work on it from there. Okay, so for the sake of this video, we found, let's say, just 2 areas, and these 2 demand areas is step number 3. Points of interest on M15 or M5 aligned with our higher time frame impulse. So it's basically look at the 1 hour time frame impulse and then M5 or M15 inducement. Once you connect those 2 things together, then you have taken a qualified POI with the right market read in the right area, because we're in discount. So far, so good. So far, very easy and simple, and it's going to be giving you high quality reaction zones for now. Next is going to be key component number 4, and this is going to be liquidity sweeps. Now, this is a non-negotiable. As you know, in all of my trades, I always follow a Trinity pattern. That is 3 clear signs that the markets are inducing, because they are creating an environment to engineer liquidity, to invite in people into the market by showing them emotions or showing them price action that they want to see, so that they get into the market, and then the markets flush them out. We invite, we entice, and we take out. That is an inducement. So when I can find these areas, I know that these areas don't happen by accident. This is not chance. This is institutional intent, because they need to generate an environment where people are getting into the market so that they can be their counterpart. If the institutions wants to buy a lot, they need to bring in a lot of sellers so that they can be matched up. Once they have had that matchup, then you know the institutions are in and a big move is about to happen. So this is a key component. With the Trinity, you have the inducement, time window, and lower time frame confirmation. These 3 things is basically the next 3 steps. So once you have in that area a sweep. Now, what is a sweep going to be? Inside of our blue boxes, we need to be seeing a sweep of a few things. It's going to be high of previous day or low of previous day. High of previous week or low of previous week is going to be high of previous session or low of previous session. For example, a London high being swept during New York window. Traps, for example, New York Open or Frankfurt Open is usually a trap time. For example, an SMC trap, where SMC traders are going to be getting in. Breakout traders trap, trend line trap, or support and resistance trap. Now, this might seem like a long list, but these are the key ones, and you don't need all of them. You need 1 or 2 of them. So for example, if I can find price action in a specific way where I'm coming into my points of interest, and inside that points of interest, as we start to arrive here, I start to see a buildup of support. Perfect. And then I see price sweep. Smart money traders are seeing that as a sweep of liquidity. And then I start to see a trend line. Now I'm really going to be focusing here, because I can start to see that we have trend line liquidity and we have a smart money trap. And for example, if this happened at Frankfurt Open or New York Open trap time, then it gives me 3 clear signs that I know I have a very high chance that I'm going to see a flush of the trend line liquidity, a flush of the smart money trap liquidity, and the timing. Because it's a trap time, I will then see an inducement of all of these areas before price shoots higher. And what has market done? It's trapped in the smart money traders, trapped in the trend line traders, and trapped in the breakout traders of the session, because they're seeing a break of structure during a session open. When I've seen a structure like this, or just a sweep of Asia high, high of previous day, low of previous day, etc., etc. These are trap times. If you don't understand all of these, don't worry. I've made a specific guide going through all of the things of liquidity with specific individual guides on what is a smart money trap guide, because that's my favorite and more advanced. So not to worry, everything on this channel is here to help you. So once I've found a relevant sweep, and again, watch the guide so you know how to qualify them, what are the invalidations, all the technical details. But very simply, you need to have a liquidity pool of interest like the ones I just listed. You need price to break through it and then give a rejection higher. Now that rejection higher is the last step. If you have in the key time window a rejection after my sweep, then I have my entry. So for example, in my key time window now, let's say it's my New York key time window, I see this inducement. And after this inducement, I see a 1 leg, 2 leg, and a break of structure. Then I know that I can enter upon this area. Stop loss can be at the low. This is my entry, this is my stop loss, and therefore I can take a 1 to 3 risk to reward scalp or intra-session trade, because I know my stop loss on average on a play like this is going to be about 5 pips, and I know the average movement of a New York window is about 30 pips. So I know that if I want to have a 5 pip entry, I need to just get 15 pips, and if the average movement is 30 pips, for me to get a 1 to 3, it equals 15 pips. Because I have a 5 pip stop loss, that means 5 pip stop loss equals 15 pips to get my 1 to 3 risk reward, and therefore that can be a very easy scalp. Market might go even higher and higher. I'm not concerned. I focus on pockets of probability. I'm focused on the key moments in a key place, in a key trend for a reaction. That's all I look for. This is data backed. This has a positive expectancy. In fact, I've made many videos proving it, shown a track record, back tested it, given live callouts for almost 2 years. Every piece of transparency and proof is there, where it's helped me make millions of dollars. And it's also the reason I've helped thousands of traders become a full-time trader, become a funded trader, or at least find their first payout through my signals, through my education, or just through this YouTube channel. It's just trades like this. When you have a framework where you find the impulse, you wait for discounts, qualified points of interest, wait for a sweep and all the characteristics of it, wait for the key time window, and wait for an M1 rejection, and go for a 1 to 3 risk reward scalp. Pockets of probability. It's more important to catch these windows of pockets of probability than actually trying to catch the whole move. By the way, if you want me to share a PDF of every definition of every component on how to build, define a strategy, not just everything I have on screen right now, which is going to help us find an entry, but everything else when it comes to take profit systems, risk management systems, overall account management systems, scaling up, then just let me know in the comments if you want to get your hands on the full PDF. And if enough of you are interested, then I'll prepare it for you in a nice PDF and I'll throw it into the comments so you can download it for free. But more important to all of this is my famous saying, and that is a restricted trader is a profitable trader.